What if the United States had not intervened to support the Japanese yen? Imagine a scenario where the Japanese yen comes under extreme pressure. Japan needs to defend its currency, and the United States decides not to intervene or cooperate. At first, it might look like a problem limited to Japan, but the consequences could spread far beyond Tokyo and into U.S. financial markets and the global economy. If the yen weakened sharply, Japanese authorities could face increasing pressure to stabilize the currency. One possible response would be selling part of Japan's large holdings of U.S. Treasury securities and converting the proceeds into yen. That is where the situation becomes much more complicated. Japan is one of the largest foreign holders of U.S. government debt. If Japan suddenly sold a very large amount of Treasury securities, Treasury prices could fall and market yields could rise. And higher Treasury yields matter because they influence borrowing costs across the entire U.S. economy. Mortgage rates, corporate borrowing costs, consumer loans, and other financial assets can all be affected by movements in U.S. Treasury yields. But there is an important point. Japan selling Treasuries would not automatically cause a financial collapse. The U.S. Treasury market is enormous, highly liquid, and supported by investors around the world. The Federal Reserve also has powerful tools that can be used if financial markets become severely stressed. The real danger would come from the speed and scale of the selling. If investors believed that Japan was only the beginning, they could start asking a much bigger question. Are other foreign governments also going to reduce their exposure to U.S. debt? That could create a confidence problem. If Treasury yields moved sharply higher, the U.S. government would eventually face higher refinancing costs as old debt matured and had to be replaced with new debt at higher interest rates. The United States would not suddenly become unable to pay its debt, but higher interest expenses could put additional pressure on the federal budget and make an already difficult debt situation even more expensive. There could also be consequences for the dollar. Normally, a major sell-off in U.S. Treasury